Let's get market reaction to Iran's strike. It was swift, with the Dow futures falling by more than 400 points overnight, but that has now completely reversed. Joining us right now to talk about the big move and then the move back is Ed Campbell. He's senior portfolio manager at QMA. Also, Julian Emanuel, he's chief equity and derivatives strategist at BTIG. And Ed, what do you think?
Yeah, so I think we're all taking a collective sigh of relief this morning compared to the initial news last night, because compared to the U.S. action, I think this does look like a de-escalation. It remains a dangerous situation, and we're going to have to watch it closely. Oil shocks caused by geopolitical crises have caused bear markets and recessions in the past, so the markets are going to be focused on that. But I think our base case here is that we're able to find an off-ramp, and things are not going to escalate to the point of a full-fledged conflict.
Julian, one of the things I'd heard speculated about is just the idea that this kind of proves that there was so much money waiting on the sidelines, because anybody looking for any sort of a pullback, if they sound like it's not going to be as dire as some of the early predictions, there are people who are willing to flood right back into the markets.
Well, there's definitely the element to that. And in fact, the market has been, for the most part, underinvested for almost the entire last year, since you had that bear market in the fourth quarter
even with the massive gains we saw last week?
Even with the massive gains. And, we've been on the show previously talking about how the hedging over the election term shows almost an apocalyptic view about election outcomes, which tells you that people are still holding back. You look at money market balances, you look at flows into bond funds. There is room to own equities. That having been said, the market volatility of the last several weeks has been probably a bit too low. Clearly because there's lots of risk out there, whether it's what we're facing over the last 12 hours, whether it's the ongoing politics in Washington, or the fact that there's questions around earnings. All of these are questions. But for us, I guess the question comes down to is there likely to be material escalation? The president's run on this idea that he doesn't want endless wars. And when you think about it, the coming into an election year, this whole idea of keeping consumer confidence high, which spurs growth, is central to an incumbent's getting reelected. And this is something that could be a threat to consumer confidence, which is why we think it'll get walked back.
Ed, a lot of the speculation yesterday, some of the market notes I was reading, had analysts saying, look, they were concerned about whether these two sides would be rational actors, even though neither one of them necessarily wants to get into a prolonged or more severe sort of conflict, that with Iran in the past, they haven't always been rational actors, and maybe the market was putting too much faith in that. Do you think that's the case or no?
Well, I think I'm going to assume that, we have rational actors here, and that, if you look at the incentive structure, no one wants to go to war. But I do think, there are situations where leaders miscalculate and, things could spin out of control. We're still overweight risky assets here. We don't plan to change that. I do think you want to boost.
What sort of risky assets?
Stocks.
Just stocks in general?
Stocks in general. High-yield bonds and emerging market bonds relative to things like core bonds and international sovereign debt. So we don't plan to change that. I do think you want to boost your exposure to safe haven assets a bit here as a hedge. So gold has just broken out of, moved above its September high, and we think we have more upside there. So, gold and treasuries, so maybe a bit of a barbelled approach where, you have some exposure to safe havens in the event that, things do go sour. But, our view is that we're likely to have another good year in global equities.